Hi everyone, my name is Chenxiang Zhang, and I am a graduate student in financial engineering. Today, I will introduce a trading strategy, pairs trade, to you. Before introducing our topic, I will first tell you some background of my major, which is financial engineering. Financial engineering is the use of mathematical techniques to solve financial problems. The mathematical tools we usually use are statistics, calculus, random process, and so on. Financial problems in financial engineering often means earning profits and hedging. So, what is the relationship between this definition of financial engineering and our topic, pairs trade today? In fact, all trading strategies can be understood from the definition of financial engineering. When we learn a new trading strategy, we can ask ourselves, what is the mathematical techniques of this strategy? What is the problem you want to solve? Focusing on those two questions of trading strategies will help you understand them better. Next, I will use pairs trade to give you an example. A pairs trade or pair trading is a market-neutral trading strategy enabling traders to profit from virtually any market conditions, uptrend, downtrend, or sideways movement. Here, our mathematical techniques are correlation, co-integration in statistics. And our financial problem here is earning profits. After introducing those boring definitions, let's now look at how to use pairs trade strategy. First, pairs trade is called this name because we need to select two stocks or two portfolios for comparison. In this example, for simplicity, we choose two stocks for explain. Therefore, to start a pairs trade strategy, we need a price information of two markets, then matching stocks with similar historical stock price trend from markets. Here, we usually use co-integration in statistics. That is, the price difference between them will swing back and forth around a certain mean. And the certain mean here, the certain mean is also equal to the equilibrium price here. So if two stocks or variables have a strong co-integration, their destination will always be the same, no matter how they go halfway. This is as shown in the lower left figure. Here we can see that the blue and the orange lines respectively represent two stocks with strong co-integration. Second, find two equilibrium price. Here, the equilibrium price is the point as close long trade. Here, we can see that this point. And then we will judge whether stock price is equal to equilibrium price. If there is no difference between two prices, we wait. If there is difference between two stock price, we then move on to do next judgment. If the stock price is larger than equilibrium price, we short stocks with higher stock price. If the stock price is smaller than equilibrium price, we will buy stock with lower stock price. In conclusion, the concept of pairs trade is to buy an undervalued target and sell an overvalued target. Investors who use pairs trade will make money when there is an imbalance between the two markets. We can see from previous slides that there are two important questions for pairs trade. First is how to choose the pair of stock, and second is how large is the spread to trade. So we look at the first questions that we usually use high co-integration and a big name company. for our stocks. The big name company like Coca-Cola and or GM or Visa or Master. The reason behind this is that many small stocks have poor liquidity and are difficult to short, so naturally they cannot be matched. Only companies with large scales are selected. Another approach is to choose one basket of targets, and the train of two is highly co-integrated with another basket of targets. Therefore, when doing a long-short operation, one basket of stock will be longed, and another basket of stock will be shorted at a time. It can reduce the extreme error of single company and ensure that possibility of convergence is increased. And so let's talk about the next questions. How large is the spread to change? First, we may judge basing on historical experience. Through the statistic of historical spread change, find out the size of spread that is suitable for entering the market. And second, use price fluctuation judgment. Calculate the average value and standard deviation of the price difference. Find the time point where the price difference is abnormal and the standard deviation is relatively large in the period of time, and enter the market to match. Then let's talk about the advantages of pairs trade. First, pairs trade only depends on relationship between two stocks being traded, not on the overall rise and fall of a market, which means whether the market is rising, falling, or very stable or high volatility, investor can find opportunities and profit from them. And second, the volatility of pairs trade returns relatively small. Third, the returns are relatively stable. And the disadvantages of pairs trade is that first, small gains and big loss. We can only by using this strategy, we can only win small gains, but we have a high risk of big losses. And second, leverage may lead to great risky because if we want to increase our gains, we may use leverage, and the leverage will lead to more risk. And third, the correlation of two stocks may change over time. So it may be difficult for us to find the convergence. So that's my presentation. Thank you.